All right. Hopefully everybody can hear me okay. I don't know why GoToMeeting went ahead and updated, and I've got everything's a little bit different. So I hope everything's working all right in the background. And I went ahead and started recording using a different software too, just in case for some reason it doesn't work. So if you guys can't hear me or can't see my screen, please let me know by texting me real quick, and I'll try to get it fixed. But otherwise, I'll go ahead and jump right in and get started. And I'm sure those that are texting me and telling me that they can't get the GoToMeeting to open up, I'll get you the recording here after a while. All right, so big day up yesterday, and kind of a lot going on in the marketplace. So as far as I can tell, we need to take a step back and try to make this thing as simple as possible. So when we're looking at things in the grain market, fundamentally, what we need to pay attention to is the ending stocks number, right? And this is I'm trying to make this overly simplistic. As this ending stocks number drops, prices tend to go up. As the ending stocks number grows, prices tend to go lower. And what we've been dealing with is over the last few years is a very, very high ending stock number, and basically nothing can make it go down, right? The only thing that we've been able to really rely on to make it go down is a weather event or a drought, and we just haven't had that. So we've been talking about we need a demand-driven market. Well, we're finally getting that through China's buying, right? So we're starting to see this number come down. Here are the ending stocks numbers as reported by the USDA since May. We've gone from 3.3 billion to 1.7 billion as of yesterday. When we were in September, this was the September report right here. We said, here's the bullish case. The bullish case is yield dropping, and we end up with a 1.7 or a 1.8 billion bushel carryout. The USDA did that yesterday, and they did it even more extreme than we thought that they would or could. And here's the deal, is that it can get even more extreme than this. And we're going to get into that here in just a second. And this is a really important development, because we've been talking about the soybean carryout dropping for the last couple of months, and we've been talking about it dropping as significantly, right? Like we've been saying, hey, the bean yield isn't there. China's going to implement its phase one. They're going to buy all the beans. They bought all of South America's beans. And so yesterday, the USDA confirmed that, hey, yes, that's all true. And now we're talking 190 million bushel bean carryout. So what's coming is probably more important than what we have, because what this means is that we now really need acres, and front and center is next year's production. Because if we do, we're gonna do a lot of if games moving forward here. If we get into a weather situation in the U.S. in next May, June, and July, then this balance sheet could get extremely tight, and the market's job is to discount that possibility, right? So from a fundamental perspective, we're now talking about, okay, the demand is there, our balance sheet is tight. Can it get tighter, and what might make it happen? Obviously, if we keep buying more, that we can get tighter. But now I think we're going to shift, and we're going to say, if South America stays dry and that weather situation really becomes dire, then that puts more pressure on our crop, and that just builds in the next year. And what's underpinning all of that is the weather development in South America called La Nina, right? Which is more of a drier pattern. And if that La Nina continues through our winter, then that starts to impact our crop. So the significance of the USDA reducing the corn piece is that up until yesterday, corn really hasn't been tight from a ending stocks perspective. 2 billion, 2.5. We don't need higher prices there, right? We need to continue to encourage feeding. We need to continue to encourage usage. So we don't have a supply problem in corn yet. If the significance to me of yesterday is that this creates the acreage battle, because now we don't have a 500 million bushels of wiggle room in our corn supply. Now corn really does need to ensure its acreage base, and it can't just puke up 6 to 10 million acres to beans. It's now got to defend them. And I think that's the recipe that we need for really much, much higher prices. So from a super simple perspective, if we're looking at this from a historical perspective, this was a game changer yesterday, and we need to look for the possibility that that is going to tighten and the market's going to discount that. So where is this in perspective of older carryout reports? Well, here's soybeans, and this comes straight off of K-State's website, Ag Manager. They have really, really good information. If you're looking for info, I highly recommend visiting and going to check out Ag Manager. This is the ending stocks to usage for soybeans as of yesterday. Now, if we look back here, you will see that there's only 1 year that's below where we are right now, and that was 2012, when beans were much, much higher priced. So there is a definite possibility here that if this balance sheet continues to tighten, that we need to go higher to ration demand, and to buy acreage going into next year. So from a simple standpoint, don't fight it. It is what it is. We could easily continue in this tighter pattern. So how does this flow through the technicals of the market, right? Like the fundamentals, where we really look at the balance sheet and the ending stocks number and to gauge where prices might go, the technicals aren't any more difficult than that. We're looking for either higher highs and higher lows, or lower lows and lower highs, and that defines our trend. And what we've seen here, it's crystal clear. You can see it. This is a chart of corn. We have higher highs and we have higher lows. Corn is in an absolute uptrend. There's no question about it. We start to use these other indicators to help us identify when that trend might end or reach an exhaustion level. There's nothing more to it than that. And when there's a huge move underway, you got to start looking at higher time frames to gain yourself some more perspective. So while someone might look at this corn chart and say, "Well, it's got to be done," it can't go any higher because, oh my gosh, we've got some we've just gone too far too fast. I'm reading that a lot. Well, if you look at the weekly chart, let's back out and look at it. There's nothing about this that says that we're anywhere near done. Yesterday was a big deal because we just broke out yesterday. This is day one of what could be a much, much more impulsive move. And there's really nothing between here and 464, which was last year's high. There's really nothing between here and 464 to stop us. And as far as I'm concerned, we may very well blow through this and work significantly higher. There's a lot of guys, as you read them, that are talking about potentially corn moving another $1 from where we are. I don't think that happens, all in a day, but it can happen pretty darn quick if things don't materialize. So yesterday was a big deal and something that a lot in the trade have been looking for. And I don't think even a pullback here represents a bottom of any kind. I think it's more of a buying opportunity than anything else. Okay, so let's go back to soybeans here. No different than corn, beans are in an uptrend, right? You have higher highs, higher lows, and they are in an uptrend until they aren't, which means that we've got to see a pullback, a rally, and then a pullback, and that subsequent low break. We have absolutely no reason to think that this thing is going to end anytime soon. So as you get these big blow off days like we had yesterday, one might say, well, it's a blow off top, right? It's trend exhaustion, and it could be. I mean, we've come really far, really fast. I mean, shoot, we've moved a buck in 6 days. So it could be a blow off top, but it also might not be. And the only way you're going to know is when it happens. So the best thing that I can say to anybody looking at this is the trend is your friend. We're in an uptrend, and we are until we aren't. And the only way we'll know is when this price action starts to break and really confirms itself in an impulsive manner, right? Other than that, we're just chomping through all kinds of support and resistance. So let's go back to the weekly on soybeans. We talked about this for weeks, about beans breaking out of this congestion zone. This is where the trade war started, right? This is the week of the trade war right here. We spent a lot of time coming back up into this range. We finally broke out of it last week, and we finally closed up above these significant levels. And now there's nothing between here and really 1208, between 12 bucks to get in our way. So to think that the market's done, I don't think is a great conclusion, because there's nothing to stop it here in the meantime. Now, China can come in and try to manipulate the number by canceling purchases and all these other things, but can they? Because they need the food. So I don't think it has as much to do with phase one as it does. They're just out. So I think this is just going to continue to march up into here, and then we'll see. And if we can get above it, then the sky's the limit. We can easily see $13, $14 beans if we can break up through here. So I would absolutely not short this market. I would not get in its way at all, and just continue to repeat the mantra. It's in an uptrend until it isn't. And the only way to identify that is when it happens. There's no other way. You just got to sit back and let it keep going. The one thing that I don't love, and we're going to pull this out here and take a look at this. This is here, get to the daily chart. This is November 21 beans. It's only at 1024 versus 1150 on January. So we've got a $1.30 inverse to next year. That tells me that we haven't even started our acreage battle, and we might very well start working much higher in the new crop beans. But this is a wintertime thing. I don't think that happens right away. But this is where that acreage battle's got to happen. And so if you're looking to re-own, this is where you do it, because it's got the upside potential, because it's already $1.30 behind where the rest of the market is. And you can see the same thing in corn. If we go back to the daily chart and I go out to December of 21, we're only at 407 in corn. So you've got about a 13-14 cent inverse in from December to December on corn. You've got a big inverse through July, and then you get into September and into new crop, and that inverse it just starts to taper off. So the out months are discounted to the front, and we would be looking for those to pick up some strength into the winter to carry. So I wouldn't be making any new crop sales, because those markets just aren't high enough, and they haven't really engaged into that acreage battle. I think it's worth taking a step back and letting that play out, and just allowing the market to do its thing here for the next few months. Wheat is an interesting one as well. With the dryness in the plains and some production issues abroad, the wheat market's not quite as attractive as corn and beans, but it's developing its own story. And if we're able to rally a little higher here, and this is March beans, and take out this 586 level, then beans can go much, much higher. And the catalyst for that could be China, because the price of corn in China is so high now, it's now more expensive than beans, or than wheat. So they've started selling wheat out of their reserves, which is going to put pressure on the global wheat supply. And if corn here in the U.S. starts to really accelerate higher, then that's a very bullish catalyst for wheat as well. And wheat can easily take out $6 and blow, just keep right on marching, because it's going to have to kind of revert to its normal, which is Kansas City trading to a premium of corn and trading to a premium of Chicago. I don't have time to go through that spread here, but that Chicago-Kansas City spread has started to move. And we're looking for Kansas City to gain on Chicago and outclip it to where it's trading a 10 to 30, 40 cent premium to it, as the hard red winter wheat becomes more in demand and more important to the marketplace, because our glut of supply has just started to erode and deteriorate. So we're looking to own everything at this point. Breakouts need to be bought and followed, and I think pullbacks need to be bought as well. And we're going to keep saying that until this trend stops. We were hoping for a deeper pullback in beans to where we could have gotten them bought a little bit cheaper, but the market didn't reward us with that and just kept on going, which is a testament to how strong the move is. And so I think you just gotta suck it up and go with it, because it's going to keep marching higher, and it will until it doesn't. So I hope that's simple enough, and I'm gonna kind of shut things down by saying, hey, this is risky business, right? And you've got to be careful trading these things, because you can lose money in them. But it's also important to be mindful of your farm situation and taking positions so that you can protect your revenue and protect yourself as these grains reward you with higher prices. So if you have questions, call me, and I will talk to you next week.